In an unprecedented move, President Donald Trump has escalated the US-China trade war by imposing sweeping tariffs on Chinese imports. On April 2, 2025, through Executive Order 14,257, the administration declared a national emergency over persistent trade deficits and introduced tariffs reaching up to 245% on Chinese goods. This aggressive policy shift has led to immediate disruptions in global trade, with an estimated $2.8 billion worth of goods stranded at Chinese ports due to halted shipments. American companies are now urgently seeking alternative supply chains, turning to Southeast Asian nations like Vietnam and Indonesia. However, these regions are struggling to accommodate the sudden surge in demand, leading to production bottlenecks and increased operational costs. The abrupt nature of these tariffs has left businesses scrambling to adapt, highlighting the fragility of global supply networks. But can the US really afford to sever ties with its largest trading partner without a clear backup plan? And will this bold move spark a new era of economic independence or ignite a global trade collapse? Before we dive deeper into the full scope of this crisis, make sure to like this video, subscribe to the channel, and hit that notification bell so you never miss an update on stories that could reshape the global economy. The redirection of supply chains to Southeast Asia has not been without challenges. Manufacturers in these regions are overwhelmed, leading to significant delays and increased costs. Logistics expenses have surged, and the limited infrastructure is ill-equipped to handle the sudden influx of orders. Meanwhile, China has refused to lower prices or offer concessions, maintaining a firm stance against US pressure. This standoff has resulted in American consumers facing inflated prices across various sectors. Retailers like Shein and Temu have already announced price hikes, with some items seeing increases of up to $150 by June 1. Major retailers such as Walmart and Target have also indicated that they will pass on the increased costs to consumers. The Federal Reserve has expressed concerns over the inflationary impact of these tariffs, warning that they could jeopardize economic stability. Despite these warnings, the administration remains steadfast in its approach, emphasizing the need to rectify trade imbalances. In response to escalating tensions, China has accelerated the deployment of its digital currency, the e-CNY. Designed to modernize the financial system and reduce reliance on the US dollar, the e-CNY has been integrated into various sectors, including retail and cross-border trade. The People's Bank of China has reported significant adoption rates, with millions of users and substantial transaction volumes. The e-CNY's integration with the Cross-Border Interbank Payment System (CIPS) offers an alternative to the SWIFT network, enabling faster and more secure international transactions. This digital currency not only enhances China's financial autonomy, but also positions it as a formidable player in the global financial landscape. By reducing dependency on traditional financial systems dominated by the US, China aims to mitigate the impact of sanctions and trade restrictions. The adoption of the e-CNY has catalyzed a shift in global trade settlements. Countries like Argentina have transitioned to using the yuan for trade with China, alleviating pressure on their dollar reserves and streamlining transactions. This move signifies a growing trend of de-dollarization, as nations seek alternatives to the US dollar in international trade. The programmable nature of the e-CNY allows for automated payments and smart contract integration, enhancing efficiency and reducing transaction costs. As more countries adopt this digital currency, the traditional dominance of the US dollar in global trade faces increasing challenges. While the US employs tariffs and sanctions as tools of economic pressure, China leverages its technological advancements to counteract these measures. The widespread adoption of the e-CNY across Belt and Road Initiative (BRI) countries exemplifies this strategy. By offering an alternative financial infrastructure, China reduces the effectiveness of US sanctions and promotes its own economic agenda. The competition between these two approaches, traditional economic sanctions versus digital financial innovation, highlights a new dimension of geopolitical rivalry. As China's digital currency gains traction, the US may find its conventional tools of economic influence less effective. Along with that, in a strategic move, China has imposed export restrictions on key rare earth elements, essential components in high-tech and defense industries. These restrictions threaten to disrupt global supply chains, particularly affecting U.S. companies reliant on these materials for manufacturing electronics, military equipment, and renewable energy technologies. The U.S. faces significant challenges in sourcing alternative supplies, as China dominates the global production of rare earth elements. This development underscores the vulnerabilities in critical supply chains and the potential consequences of escalating trade conflicts. The financial markets have responded with volatility to the escalating trade tensions. Major indices have experienced significant fluctuations, with tech giants like Nvidia and Tesla reporting substantial losses. Investors are grappling with uncertainty, leading to decreased confidence and increased market instability. The broader economic implications are profound. Supply chain disruptions, increased production costs, and inflationary pressures are converging to create a challenging economic environment. The long-term effects of these developments remain uncertain, but the immediate impact is a heightened sense of economic vulnerability. As the economic consequences of the U.S.-China trade freeze deepen, political blame games are heating up in Washington. President Donald Trump, who returned to office in January 2025, has defended the tariffs as a long-overdue correction and claimed that former President Joe Biden left a crippled trade policy. However, data from the U.S. Bureau of Economic Analysis suggests that the economic slowdown and inflation spikes accelerated only after Trump's April 2025 tariff executive order. Mainstream media outlets and independent economists are pushing back on the administration's narrative. Reports from the Brookings Institution and the Peterson Institute for International Economics indicate that while the intent was to restore American manufacturing, the sudden nature of the tariffs has led to over 78,000 layoffs in logistics and retail sectors by mid-April. With shipping halted and consumer prices soaring, everyday Americans are feeling the brunt of the policies. Public opinion is also turning. A Gallup poll published on April 16, 2025, shows 62% of Americans disapprove of the new tariffs, with many expressing concern over rising grocery and electronics prices. Small business owners, especially those dependent on affordable imports, are speaking out. Many warn they might be forced to shut down if prices continue to rise and shipping delays worsen. Critics argue that Trump's strategy might backfire economically and politically, especially as key swing states reliant on international trade begin to feel the economic strain. Yet Trump remains firm, insisting that short-term pain will lead to long-term gain, and urging Americans to buy American and hold the line. Do you believe this trade war is a bold stand for American sovereignty, or a dangerous gamble that could wreck the economy? Share your perspective in the comments. For more updates on this fast-moving story, don't forget to like, subscribe, and hit the notification bell so you don't miss our next video.